Hello and welcome to Commodity Culture, where we break down the commodity space for both new and experienced investors. Before we get started, standard disclaimer, nothing here is investing advice. Do your own due diligence. And today on the show, we have chart trader and co-founder of Northstar Badcharts.com to educate us on technical analysis, Mr. Patrick Karim. Welcome to the program.
Hello, Jesse. I'm not sure about educate, but we'll definitely try to shine some light there on the value of charts there to remove all that noise and fear that's going around.
Great. Well, before we dive into that, I like to start off with everybody's origin story when I have a new guest on the show. So how did you discover investing? What is the road that led you from there to where you are today? And specifically, how did you get attracted to charts and technical analysis?
Well, I remember like when I was maybe 11, 12, like our parents used to put money aside. And then I don't know, I had maybe a few $1,000s. I don't know how much. It was in the late 80s. And then my parents were divorced when I was 12. My mother's boyfriend, he was aware of mutual funds, investing money. Like he was all into that stuff. And he told my mother, says, your kid has money. He shouldn't just leave in the bank. He should try to invest it. And like, I didn't know anything back then. And they put it in was it mid 90s or something before the tech bubble. And they put it all in the technology, internet, mutual fund there, whatever it was back in the days. And then that just went up. And whether it was a good first experience, that money permitted me to buy my first house when I was, I forget how old I was, in 2001, when I was 25. I bought a house. That was the down payment, all that stuff, just because of, but that was just pure luck, right? They put in the fund. It was the bull market just starting in US equities in the tech bubble. And I sold it. Yeah, when I bought my house in 2001, actually, I probably cashed out when that thing was topping. Pure luck. I need to buy a house when I was 25 to add a motorcycle. And I wanted the garage to put a motorcycle in. I was tired of leaving it outside. So actually, I bought a garage that had a house attached to it. And that was that. Then years later, I started consulting in the IT world, making a little bit more money. And then I said, man, I have to start investing that. But like a lot of people, I Googled and I fell on the penny stock forums. It's like the analogy I say, if ever you go on vacation, you go to Paris, you get off the airport, they bring you to Champs-Élysées. Those restaurants, the first ones are tourist traps. They might be good restaurants, but the ones are going to pay more expensive. You won't, they'll rush you. They just next. They don't care about you. The real restaurants and niche restaurants are hidden in an alley where only friends you make over there after years, they'll tell you, Patrick, this is the good restaurant. I know the owners, that's better. So that's what happens to a lot of people who have money and say, I have to invest. They hear about other people making money. They Google, they fall into the penny stock scams. They go in the forums, they don't look at TA, they're buying in fear of missing out. Oh, Bitcoin's at 65,000. I'm buying it. Michael Saylor's saying it's going to 1 million. How could I go wrong? This guy, he's telling me he has a reputation. But people, if they would have looked at the chart, they would have said, oh my God, I'm stretched from the moving average. I've been in a 10-year bull run. This thing is due to correct, top, and then we'll see after that. So I got super lucky in my initial investments. Well, like my penny stock, all the crap I used to buy. It's like super lucky I didn't get wiped out many times. And then after that, I read a book called from Stan Weinstein called Secrets of Profiting in Bull and Bear Markets. And then he, in his first chapters, he says, look, nobody wanted casino stocks back in the early 80s. People said the fundamentals suck, but he saw on the charts that they were basing, the price action was basing, the moving averages were turning up. That means the price action was above the moving averages. He says, I'm going long in these stocks, while everybody, mainstream, whatever, they said, don't touch that. And he always made the fact that the ticker, the top left, could be bananas, ABC, whatever it is, doesn't matter. If the chart's telling you it's a buy, it's a buy. Don't wait for the media to confirm what you want, because after that, you're a victim. Because after that, the media is always going to be able to spin the news every which way to get clickbaits. Can you trade on that? Like on one day, they say, oh, it's the end of the world. The next day, they say it's the best day. Like how the hell are you going to trade that? How are you going to ride a 10-year meaningful trend if your trading framework is listening, waiting for CNBC to tell you to do something, you know? And that's another thing I learned from the mutual fund guys. They never tell you to sell, never. It's like, I put a poll out on Twitter. I asked people, does your financial advisor call you and tell you, hey guys, look, the price action's topping, you should sell, you know? So they never do that. So that should give you some big warning signals. Hold on, they tell me when to buy, they never tell me when to sell. How do I figure this stuff out? And the only way to do it is using charts. So that's where I am today. So after reading Stan Weinstein, then after that, that was fine. That would open the gateways. And then I started observing, doing my own observations, testing different technical indicators, like going through the whole range until you find something that fits your emotional profile. Some people, they like short day trading, scalping, fine. I like more bigger picture. I want to be able to ride those long, meaningful trends. So then you adapt. You have to be really comfortable with your trading framework. But I just didn't want to get wiped out. And with chart trading, you're able to apply sound risk and money management. I don't know how you could do it with anything else, but applying risk and money management for chart, it's easy because you have an entry price, you have a sell stop, that's your potential loss. Then you have a reward based on classical chart trading, you have measured moves. So now I know that I could lose 1 and win 8. That's great. Even if I'm right one time out of 3, I still make tons of money because I'll get 8 versus losing 1 every single time. You can't do that with fundamentals. Like I don't know how people could have these parameters without looking at the chart, knowing exactly when they want to exit, when it's time to exit on the profit or on the sell stop, when to enter. Charts answer all those questions.
That was a great breakdown, and you kind of partially answered my next question, which is why is technical analysis so important? But maybe you could bring up the chart you were speaking of or another chart just to kind of give us some examples of how you use technical analysis.
Let's do it interactive, guys. Nothing better than a little show and tell interactively. I have here the gold versus SPX chart, and I'm just going to put it on the monthly chart. I'll remove all indicators, clean it up on the line chart. So essentially, once you've identified 2 major asset classes, let's say gold, which represents purchasing power destruction, commodities complex, and SPX, which is, even if it has sectors that represent commodities in it, it's heavily weighted. It's like 5 or 10% is energy, commodities, basic materials, very low. It's mostly growth stocks, price to earnings, expansion, etc. So when I look at that chart, then let's say I overlay the ASA chart. ASA is the precious metals fund, the miners, gold and silver miners. And it's one of the oldest ones. Nobody talks about it. People talk about JDX, all that. Look at that. Look how well it tracks it tracks the capital flows of gold to SPX. So it doesn't matter if gold to SPX chart is going up because gold is going less or it's going down less than SPX, right? Because the ratio could go up. If gold goes down less than SPX, then that ratio is going to go up. It just tracks the flows. And you could see over the years, the amplitudes, yes, are different, but the direction, look at that, the 2000 bottom here, the direction is the same. So I don't need, if I'm a CEO of a company or anybody who wants to invest in precious metal sectors, all the news you'll see, oh, they drilled a hole, it's the next bonanza. It does not matter because that same drill result could have happened here. It could have happened here at the end of a 10-year run of gold outperforming SPX. I'll minimize here. So here is gold outperforming SPX from 2000 all the way to 2012, 13, until gold broke down here. You could have had these great news, but if that great news is happening below this line, the sleep mode line, it's not going to drive the price as much, or it's probably going to be dismissed. There are exceptions. There's Kirkland Lake Gold. There's a whole bunch of like these exceptional, but most of the stocks in the precious metal sectors will not move favorably, no matter what the news is, if it's on the wrong side of this trend line. And here's the next one. This is the one I've been looking at. This one here and this one here. So I'm going to minimize again the gold and silver miners. Here is where the gold versus SPX chart is, Jesse. It's super close to tempting a breakout of this line here. This is the equivalent of the bull run that started in the early 2000s when the US equities were rolling over because of inflation, because of blah, blah, blah. The capital flows going into gold instead of SPX. We're back here. We're back at these levels. And even the 60s here, I could draw this line here. There's one here. There's a less slanted one here. You can't see that without the charts. Who can see that without the charts? Like, I don't know how they do it. They're magicians. You could change it but here, what I know is until this line is broken, stay clear of gold and silver miners, guys. I don't care about the stories. Until this line is closed, the probabilities of a sustained move in your gold and silver miners will be subdued. And I could even overlay here the uranium, the uranium miners, same thing. Look at that, it tracks it. Gold, uranium tracks it here. See, it's trying to go up. It's not quite doing it yet. So all these sectors, they're going to go ballistic. Uranium, anything that's real, like it drops on your foot, it's something real. They're all going to go nuts once gold breaks out versus SPX. So that's how you have to leverage that. Understand the pyramid, asset class, where the flow's going. Don't fight those. These are macro tidal waves that change every. Here's another one. Here was the crash of 2029. Gold started outperforming SPX back then. Even if gold was pegged, I could have done this versus silver. It was not pegged, or versus oil. The chart would have looked the same. We're back at historical low levels. Look, we're back here where the same levels where it broke out in the 1970s in favor of gold. Here was a dot-com bubble, super exaggerated, of US equities outperforming gold. So we're right here. All we have to do now is wait until that breaks out to the upside and then buy the dips. But look, there's other evidence that the US equities by themselves are starting to severely roll over. Here I have my heat map. I have a whole bunch of moving averages, a spectrum. Here's a 700-day moving average. Here's a NASDAQ just going up. So the moving average, essentially, I could remove the price action and I'll remove the shorter moving averages just to remove noise. So I have the 50-day moving average all the way to 700-day. So when they're all going up, when the shorter term moving averages are able to outpace the longer term moving averages going an uptrend, that's beautiful. You ride that. But once the shorter term moving average start going below, cascading through the other moving averages, and now they're starting to all go below the longer term moving average, it's sayonara. This is game over. This chart, I'll show you. I did it here for my on Twitter. Here is actually the SPX divided by producer price index for the inflation. I don't know how people how they think we're not in an epic bear market, because this triangle here, this is the 2008 market. I just did a triangle to frame all that range of moving averages I showed you on the other chart. I did a line here, go up here. I just took that exact frame, exact size. I overlaid on the 2001. 2001, same type of pattern, just more elongated, lasted longer than the 2008 crash. And right now we're kind of tracking what happened in 2008. Here are my shorter term moving averages, longer term. They're tracking pretty much what the momentum, the velocity of the 2008 crash. It could change. It could be maybe go like 2001. It could turn back up and go back above this line here. And then it's over, guys. Bear market's over. But as long as all those moving averages stay within that expanding, descending triangle, the bear market rallies are just that. They're bear market rallies. So don't let yourself influence, guys, by CNBC. There's a 8% update in Bitcoin. Oh, it's back on. It all depends when that is happening. If Bitcoin was correcting and going up 10%, but on the other side of this red line, the moving averages are not below it, they're above. Like here, Bitcoin, like originated in 2011, any of one of these pullbacks towards that red line, fine, buy the dips. That's a great opportunity to buy it. But now they're happening on the wrong side. And because the price is below these moving averages, they're resistance. So you have less probabilities, and that's what charts are about. They're not about absolutes and predicting, forecasting to the perfection of the future. It's just that these are increasing the probabilities that any price action going up will get subdued and get brought back down. Just like here was the inverse. As these shorter term moving averages were catching up or letting that longer term moving average catch up, that longer term moving average was actually serving as support. So you were on the good side. All these were great buying opportunities for the NASDAQ, but not anymore, guys. It's totally breaking down. We're back. I'll put the SPX. We have more data. Reset chart. We're back here, guys. It's starting to turn over. Here is nominally the SPX. So it's still above its long-term moving averages. the price is starting to dwindle below, but adjusted for inflation, and that's the big cause, that's the producer price index. That's what breaks down US equities. It's just a new cycle of inflation. So the US equities start breaking down versus inflation, then that money, the growth stocks suffer. I don't know, the price to earnings, whatever, the fundamentals, they start shrinking, the margins, everything costs more, they're selling less stuff, all that fundamental stuff, a symptom of the price action. Then eventually, whatever those pension fund managers, those hedge fund managers, all these guys are gonna have to, they're looking at their numbers and say, oh my, like, I have to allocate money to something else, right? And then they'll look at outperforming asset classes, energy, commodity, the metals, and then just a little bit of money goes in there, doesn't go into the SPX, and the SPX might come back nominally a little bit afloat, but you'll notice it's the sectors, the basic material sectors, the energy sectors, which grow, which help nominally keep the SPX afloat. But we might start a bear market in US equities where 5% is in basic materials or in energy, and by the end we might be at 8 or 10%, and that helps nominally keep afloat the US equities.
I will be co-hosting the Kinvestor Battery Metals and Mining Conference on November 22nd at 9 a.m. Pacific Time alongside Gwen Preston of The Resource Maven. We've got some great companies who are going to be presenting and answering your questions live, including ISO Energy, Suma Silver, Sigma Lithium, and more. So click the link in the description below this video to reserve your spot now, and I'll see you guys November 22nd at the Kinvestor Battery Metals and Mining Conference. So if we're going to see this extended bear market in the broader equities, what should investors be doing now? Should they be sticking to cash and precious metals, or are there any sectors that still present an opportunity here?
Well, what created the transition from SPX breaking down versus producer price index, it was the energy play, right? The energy, creating the inflation, the extra costs for all those consumer goods that you guys buy that are produced and seen in the producer price index. The tankers look great. The oil tankers, they're coming out of huge bases. So that was a great play that started all the way back. Even to today, there was a consolidation. So they're still looking pretty good. The dollar was great also if you did to hold while the capital flows are leaving growth stocks. Got to go back to that first chart, guys. Don't pull the trigger too early. Wait for gold to actually break out versus SPX, and then you'll be, all your miners, even the ones with no mining permits, they'll look great, guys. It doesn't matter. It's like all the money is going to be sloshing in everywhere. We're going to have our Michael Saylor one day. I don't know who's going to represent the precious metal sector, but one day we'll have some crazy guy and or Cathy Woods and talking about precious metals like the next best thing. It's going to happen one day, but not now. Maybe in 10 years when we start peaking. Right now, people throw rocks at us when we talk. When I tell them my crazy targets for gold and silver, people they say, Patrick, metals suck. Yes, they do suck, but they will not suck as soon as they break out versus the SPX.
Yeah, that's a really good point. Sentiment is very low on the precious metals. So when do you, I know this is obviously impossible to predict, but approximately when do you see the reversal happening according to the technical analysis you're doing?
In 2001, 2008, when NASDAQ broke down and closed below its 3-year moving average, look, it took 1 to 3 months for gold to bottom and then decide to go the other way around. Right now, like you saw the SPX chart, where they're starting to close and staying close below their 3-year moving averages. So, and you saw how close we are, the gold to SPX ratio, like we're hogging the line. So each of those candles was a monthly close. So do we need 1 more month, 2 more months, 3 more months? I'd say we're a few months away from closing above that important breakout line. We just don't know, but we're within striking range right now. It's not like we're super far away from a breakout line. And Patrick, what are you talking about? It could be years. Now we're super close. So we just have to wait until that breaks out. But yeah, I'd say months for now, but just keep an eye on the chart. I'm just looking at the chart. If the price action goes down and decides not to break out, there's no, this is a basic premise of chart trading, guys. All these roadmaps, these targets, a chart pattern is only a chart pattern once it completes. Before it completes, it's a possible, let's say it says it's a possible rising channel, possible triangle, whatever these fancy names you got. it's nothing. It's just morphing into existence. We're observing that the price action is respecting a horizontal line, resistance, it's respecting a support line. Until it closes above that line, the market has told us nothing. It's just telling us I'm basing. So all these targets, all times to reach those implied measure moves, all that stuff gets enacted once we close above the line. So yes, I don't know, I'm guessing 3 months before gold breaks out versus SPX, but that's not the measure to judge the forecast. The forecast is once we close above that breakout line, then check it out, go to for a successful bull run. If we don't get a successful bull run after we close above that breakout line, and it does happen, they call that false breakouts, but the odds of are lower than having a sustained run. And it's all about using TA there to be on the right side of those probabilities.
So what is your view on the oil and gas sector as we sit here today? You already talked about energy, oil tankers, but in terms of the long-term picture, maybe from a more fundamental standpoint as well as technical, because I believe hydrocarbon use is only going to increase and not decrease in the years ahead. So what are you seeing in the oil sector long-term?
Well, yeah, I did some long picture charts. So for gold, for oil, like I wouldn't be surprised to see $300 barrel of oil, maybe 800 later on. But you can't be impressed by those numbers because essentially they're just printing, adding zeros. Oil, a barrel, I don't know, used to be under $1. Then after that was $20. Then after that, it's over $100. So I'm just adding zeros magnitude, but it's not the end of the world, right? They're just printing more money. They're just adding zeros to stuff. What you got to look more is more like a ratio of how oil is expensive to, let's say, gold. And that's when, let's say, the price of something is stretched versus the price of something else. That's when you have stresses in the system. If oil price goes up too fast, too high, versus, let's say, the gold price, then you could say, oh, something's going to break. There's a lack of liquidity in the markets, or it's sucking out too much money via inflation, and then it breaks down. The price of oil goes down. And then until it gets uber low, like in the March Madness of 2020, the ratios were telling you, man, it was screaming oil was cheap, not just a nominal price, but versus all the other asset classes. Historically, it was a great time. So oil has a bright future. And guys, again, if somebody says $300, people, if you don't have a chart in front of you to see the zigzags, of course, a human's going to think a straight line. And then oil goes to, let's say, 100, it goes down to 60. Oh, Patrick, you told me 300. Well, there's support and resistance lines all over the place. Price action goes up, it tests a new plateau, fine, there's resistance. Price action goes back down to test the previous plateau. Oh, it holds. Oh, that's support. I guess this is a new plateau. And then price action goes up. So over like 10 years, yeah, $300 oil, no problem. I don't know about the fundamentals. Again, all the same stories we could have today, if I would have placed them at a different moment in these cycles of capital flows, the price action could have been subdued or accentuated. Because I'm pretty sure in 2011, 11, 12, people were talking about $5,000 gold. And it just wasn't meant to be because it was already starting to break down versus US equities. The ratios were stretched in favor of precious metals or oil versus US equities. It was just the pendulum swing. The move was done, guys. So no matter if people say, oh, Greece default in 2011, gold has to go up, it's the end of the world. I actually don't like hearing about bullish fundamentals for oil. I don't like hearing that there's going to be less or there's a production cliff or whatever you want to call it. I don't like hearing that stuff. I want the price action to go up when there's only bearish news. Let's keep the bullish news for the blow off top at the end.
So I wanted to ask you about uranium. What do the technicals look like for you there? Because I know you're saying that you don't want to hear the good news. What you want to look at is the charts and what do the charts say. But the fundamentals for uranium right now just seem to be getting better day by day. And again, that's looking at the headlines, of course. But I do feel like it hasn't caught on in the broader investment community. Like there's not a ton of institutional investment, etc. From a technical perspective, how do you view uranium right now?
Well, uranium is super powerful because it broke out. Uranium, the metal, the Sprott uranium physical charts broke out versus SPX, broke out versus the NASDAQ. It's front leading gold on many aspects. The charts, they look great with huge bases. A lot of the miners, they broke out. Now they're consolidating above rising 3-year moving averages. I don't know if the consolidation is done yet, but they seem recently. I've looked. They started waking up from their pull flags, so it's a pattern where you explode out of the base, and then you consolidate sideways above support. They're trying to try to do another leg up. That would be awesome if it would coincide with gold actually breaking out. The timing of gold breaking out versus SPX, like you said, that institutional investment will start coming into the uranium even more in a more substantial way once gold breaks out versus SPX. Uranium, it's candy what it did right now. Like it's gonna go ballistic. The chart of Cameco from 2001 and even the uranium chart from 2001 to 2007, I don't know, when like 50 months in a row it went up, or quarters. Like it was totally bonanza when once the money of the flow started coming in. And I'll mention this: uranium and oil at the beginning of a bull market in commodities, they're the fastest runners. From 2001 to 2, they actually peaked. So in 2007, uranium and oil peaked first, then they crashed in the 2008 crisis. And when they tried to rally again, they did marginal new highs, or they weren't able to really go in 2011, go much above their 2007. While gold and silver, they're more the closers. You know, gold opens the spigots, and then it lets all the friends run loose crazy. And gold and silver love closing up the show at the end of the precious metals bull era. So yeah, uranium definitely a strong horse in the commodity complex. Once the valves open there, it's going to be great. And you're right, that's another thing we have to nuance. There's news, but let's say you're a uranium aficionado and you're, oh, I love uranium fundamentals, but you're right, until CNBC talks about it, is it really contrarian news to play? You know, it's like until there's a Michael Saylor saying he has the green uranium eyes instead of the laser eyes, then we're good, guys.
That makes sense. I like that. Are there any other commodities out there right now that are catching your eye that you're bullish on?
Sugar. Sugar has been one of my favorites. It's super inflation sensitive. It looks super strong cycle. So it broke out of the base. Now it's consolidating above moving averages. That thing's going to look good. And yeah, the ones that didn't go parabolic yet, they all go. If I did a chart one time, I put all commodities on one chart from 1970s, and they all have their cycles where they love to spike. Your trick is to find one that hasn't spiked yet, which nobody's talking about. Sugar is one of them. Coffee spiked a while back. Now it's like they say it's crashing. Well, it's going back down. So you want to avoid that, because whenever you have a parabolic melt up and down, you need a magnitude of time to wipe out all these. That's why people, like when they see a crash 70% in Bitcoin, they think it's going to V-shape recovery like that. No, it takes a magnitude of time, because all those guys I bought at 50, 60, 50, 40, 30,000, as soon as the price goes up to that level, they're going to want to cash out, break even. So now they could tell their wife they didn't lose any money, right? So until those guys are out of the picture, you don't want to go there. So yeah, for commodities, I like sugar a lot there, because it's the next one on the launching platform.
Fascinating. This is the first time we've discussed sugar on this program, so that's awesome. Now, thanks so much for joining us today. It's been an amazing conversation. For those viewers who want to hear more from you, could you let them know about your service, Northstar and Badcharts, and anywhere else they can find you online?
Well, guys, Badcharts one on Twitter, all that stuff's free. Big picture charts, a whole bunch of stuff. Like if you're new to chart trading, go through my feed, the chat, ask me questions, troll me if you want on my bad calls, and I'll be more willing like to explain what chart trading is, what the basic premise is. Because often we, like when Max Kaiser says it's astrology for men, it's like it's not stars buying stocks, it's humans buying stocks, human greed, all that stuff. It hasn't changed in thousands of years, our human greed cycles. So I love explaining that stuff so people can understand why chart trading works. Past behavior will give you hindsight, foresight in the future for the probabilities. And yeah, we have the website northstarbadcharts.com, which I co-founded with Kevin Wadsworth, Northstar Charts on Twitter. You could follow him there. And yeah, you could come and check out our website. But yeah, start with all the free stuff on Twitter, guys. There's enough there for you guys.
Great. Well, I'll put links in the description below to your Twitter and Northstar Badcharts website as well. And looking forward to having you back on again in the future to continue the conversation.
It'd be an honor, Jesse. Thanks for having me on.
This is the Uranium Element Cube from Engineered Labs. They're a sponsor of the program now. And the reason why is because I genuinely love this product. I've always wanted to get real uranium in my hands, and that's what this is. That crystal in there is 50% uranium by weight. The acrylic shield surrounding it reduces the radiation emitted to a very low level that is completely safe. Engineered Labs also ships worldwide, which is great. The products are made in the USA, and if you use my discount code Commodities at checkout, you'll receive a 10% discount on your order, and you will be supporting this program. The Uranium Element Cube, link is in the description below. And now, back to the program. Commodity Culture is a series on commodities and natural resources. If you would like to see more, be sure to subscribe and hit the bell notification so you're always up to date with the latest episodes.